Right, let's get you some analysis now on that repo rate decision this afternoon. Devan Murugan joins us now. Devan, the repo rate remaining unchanged.
Yes, it does. 3.5% for the repo rate, Clement. It means that your prime lending rate at the banks is 7%. I mean, it's the last thing we need to have interest rates go up at a time when economic recovery is still unfolding. There's a lot of suffocation on the economy and on consumers, but we never really expected an interest rate hike. So 3.5% for the repo rate and 7% for the prime lending rate. I want to bring in Elize Kruger. She's an independent economist, just to get more insights on this particular decision today by the Reserve Bank. Elize, thanks very much indeed for talking to us. So, yeah, some interesting remarks, and we'll go through them in a moment coming out of this particular address by the Governor, Lesetja Kganyago. But I would imagine, widely expected, the Reserve Bank was not going to move today, so your repo rate stays at 3.5% and your prime rate at 7%. I would imagine you were expecting this.
Yes, indeed. I think as it was a unanimous decision by the MPC, it was also a unanimous view from all the analysts today. So I think there was no single analyst expecting a hike or a cut for that matter today. And I think, the narrative in a large sense remains unchanged, i.e. our local inflation environment remains under control. Reserve Bank just tweaked its headline CPI forecast this year slightly upwards to 4.3%. It's still, around about the midpoint of our target band, as is the next 2 years forecast, 4.2 and 4.5. So there's, on the inflation front, no imminent need to hike rates. And on the growth side, I mean, we are hitting the one headwind on the other. So, the bank today decided to keep the forecast also unchanged at a 4.2% real growth for this year. Whereas, if it wasn't for developments in the country in the past week, I think they would have upgraded that forecast closer to a 5%.
And I think that's very interesting, Elize, because as you say, that GDP forecast remaining static. But he did weigh quite heavily on the recent events in the country, saying this could in many ways, weigh on economic growth. He spoke about the fact that it certainly weighed on investor sentiment. So, the riots that we saw in KwaZulu-Natal and parts of Gauteng certainly did weigh, according to the Reserve Bank governor, on our growth prospects, whether or not in a small way, but it did weigh in.
Absolutely. I think, if I just look at my own forecast, after the strong first quarter GDP number, I've also upgraded my real growth forecast towards 5.1%. And I think that was what we could have expected from the SARB should there have not been this occurrence of unrest. So you could easily say in the order of 0.8 or so percentage points has been slashed of what would have been the forecast today due to what happened in the country over the past week or so. So yes, and then I think one should also think about the indirect effects, and that's what he also alluded to. So investor confidence that will, remain hesitant given the play out of events. One can take this further to think about, the impact on the fiscus, as many of the companies that got hit will have losses or at least smaller profits given the events that played out, unemployment and so forth. So, there's many indirect links that will still play out into the economy in the next few years. That's also, relating to the events.
Having said all of that, what consumers would really be interested in this afternoon is looking forward in the months ahead, whether or not their cost of money would become more expensive. So, i.e., whether or not interest rates would go up. I found it, quite interesting that the Reserve Bank governor spelled out this afternoon that interest rates could be capped at these low, historically low levels for longer if inflation doesn't threaten. And I think you made that quite clear. That's an important note for consumers.
Yes, indeed. And I think especially against the background of what the SARB's quarterly projection model has been signaling, which was, I think, quite a bit more than previously, i.e., from the fourth quarter of this year, and each quarter of next year, 25 basis point hikes. I mean, that is quite, I would say, aggressive given the set of circumstances I've just outlined in terms of both inflation and growth forecasts. So I cannot quite see that playing out. And I think the SARB really see themselves as they could contribute towards our recovery by keeping rates lower for longer. because that has indeed been a good stimulant, especially for our property side of the economy and so on. So yes, I think that's important to take note of that. And, if we do see that the rand exchange rate remains fairly stable, despite, say, some movement on US monetary policy, maybe a hike in the US or so next year, if the rand could stay fairly positive, fairly stable, as has been the case, then it could be beneficial for our inflation outlook despite development.
Final question, Elize. I mean, one cloud of uncertainty that he also pointed to was one threat that could be a risk to interest rates going higher, or rather inflation, this longer term or longer expected lockdowns. Now, we never really expected extended lockdowns at the start of the year. It did come again, and that certainly weighed in on growth. So the Reserve Bank governor today, which I found interesting, saying that, longer than expected lockdowns in the near future could impact on growth. So there's a certain bit of uncertainty out there, isn't there?
Yes, but I think that would be downward pressure on growth, i.e. the longer the lockdown, the lower growth rates will be, and, potentially the longer interest rates could remain unchanged rather than be hiked. But yes, indeed, that was pointed out as one of the downside risks to growth. And with that, he also mentioned our electricity supply problems, and I've just seen that load shedding has been announced for today from 4 o'clock. So, it's never rain, but it pours in South Africa. So, having to deal with the impact of the unrest, the load shedding is always sort of in the background for us. And then the COVID-19 story, so the longer we have lockdowns, the more downward pressure there will be on the economy. So all of those, playing, in my view, into a scenario of rather interest rates lower for longer than a hike, a hike too soon, especially given that globally we've seen some noises being made by the developed economies that they're going to start to reverse their monetary policy accommodation, but it's at this point in time still very hesitant and not happening yet. So there's still a window of opportunity for the SARB to keep rates unchanged.
Yeah, well, thanks very much indeed. Elize Kruger is an independent economist, and as I leave you, I want to just go on to that remark that the Reserve Bank governor made, saying that interest rates could be capped lower for longer depending on certain conditions. Let's just very quickly hear from him.
Better anchored expectations of future inflation could keep interest rates lower for longer and can be realized by achieving a stable public debt level, increasing the supply of energy, moderating administered price inflation, and keeping wage inflation low into the recovery. Such steps will enhance the effectiveness of monetary policy and its transmission to the broader economy. Economic and financial conditions are expected to remain volatile for the foreseeable future.
Well, that's our Reserve Bank governor there, Elize Clement. And yeah, so, he says it could be capped low, that's interest rates for longer, but of course, inflation, growth, administered prices, these are all factors that they always weigh on. But it's good to see that the economy is still getting the support it needs by way of keeping interest rates where they are, not rising it.
Yeah, thank you so much, Devan Murugan, for helping us understand what that decision this afternoon means for you and I in our pockets.